Welcome back to Market News. I'm your host, and today is July 24th, 2026. If you sat through the market today, one word probably comes to mind: anxiety. And not just any anxiety over artificial intelligence. Markets delivered a sharp, headline-driven session where the dominant theme was a broad sell-off steeped in questions about whether the current pace of AI capital spending is sustainable. The Nasdaq slipped, oil and treasury yields both fell, and the Magnificent Seven, Apple, Tesla, Google, NVIDIA, Microsoft, Amazon, and Meta, collectively lost billions in valuation as investors started asking whether the spending mania that fueled this entire rally is about to hit a wall. But here is the interesting twist. While the selling was broad and aggressive, there was already a counter-narrative emerging from analysts who suggested that spending restraint could ultimately reward these same Magnificent Seven shares. We will come back to that paradox because it really is the central tension of the day. Let us start with the AI spending angst because that is what moved the needle. The Magnificent Seven were all in the red, and memory chips were particularly targeted by sellers. NVIDIA saw shares pressured despite posting solid volume. Intel was hit harder, set to end a fifth consecutive week of losses even as the company announced a new semiconductor packaging partnership with Lens Technology. Qualcomm, too, dropped about 2% on reports that it is planning chip price hikes amid rising supply costs, which is a tricky signal when you consider the broader theme about AI infrastructure economics. Now, not all semiconductor names were getting crushed. AMD actually drew analyst praise following a bullish AI event, and Vast Data announced it is expanding its collaboration with AMD to advance AI infrastructure specifically for the inference era. That is a notable distinction: inference, not just training, and it suggests the conversation is already shifting toward where AI workloads actually run at scale. Meanwhile, Supermicro Computer reported $60 billion in new orders, and analysts were pointing to Dell as a beneficiary play on that same infrastructure build-out. Intel was an interesting case study on the day. Analysts were genuinely won over by the story, the packaging partnership with Lens Technology, the fifth week of losses notwithstanding, yet the market was not exactly buying it. That divergence between analyst sentiment and price action is always worth paying attention to. On the software side, the sell-off was nearly universal, and Snowflake stood out as the rare holdout. Other software names were simply melting by comparison, and analysts were asking whether Snowflake's position is broken or just violently marked down. Salesforce, meanwhile, granted equity awards under its inducement plan for Mesh, a smaller move, but one that signals software companies are still competing aggressively for talent even in this environment. Let us talk about energy, because the fuel cell sector was absolutely decimated today. Bloom Energy tumbled 13%, Fuel Cell Energy dropped 9%, and Plug Power slipped 4%. It was a brutal session for that subsector. Broader energy stocks were mixed late in the afternoon, with NextEra Energy drawing particular attention. After a 34% run, analysts are questioning whether it is fully valued now. Coca-Cola, on the consumer side, was projected for a strong second quarter by RBC, which was one of the brighter spots in the consumer sector. The M&A world had its own drama. Paramount agreed to delay closing its Warner Bros. Buyout for months while a judge considers a challenge from 12 states. That's a significant development. A merger that many assumed was going through is now in legal limbo. And Uber faced mounting pressure as its partnership with Waymo hung by a thread. For a company whose autonomous vehicle story was one of its key investment themes, that is a serious question mark. Now, one of the most watched names on the day was unequivocally Tesla. Shares fell sharply on heavy volume, down 14.5%, trading at $319 on more than 115 million shares. Despite the aggressive sell-off, Cathie Wood added $50 million worth of Tesla shares to ARK following the 16% drop. That is a bold bet, and it is the kind of high-conviction move that defines her strategy. On the company's side, Tesla managed to avoid a door safety probe. though new rules could still follow. And separately, SpaceX delayed its Starship test flight due to weather, with the company's valuation continuing to slide. On the telecom side, Verizon rose on second quarter earnings beats, with AI deals potentially adding billions in revenue. Verizon, along with T-Mobile and AT&T, represents one of the more tangible AI infrastructure plays right now, and the market responded positively. Now let me walk you through the quantitative signals, because they paint a striking picture. A screener scanned over 10,588 symbols and flagged nearly 10,643 signals. Out of those, only 15 were bullish and 35 were bearish. That is a heavily skewed reading. The top gainers included extreme outliers. FI was up over 13,000%, with DBGI and TRIB also showing massive percentage moves. But keep in mind several of those same names also flagged as potential overextensions, which tells you how frothy these moves are. The hardest sell-offs included TPC falling over 80%, CCMD down nearly 60%, Lessel off about 45%, and NVVE slipping similarly. On the volume side, Intel's 140 million shares, Tesla's 116 million, and NVIDIA 110 million were the most actively traded large caps. We also had a handful of individual stock signals worth noting. NVIDIA and Microsoft were leading the push for OpenAI models following the launch of Kimi K3, which is an interesting development for anyone tracking the competitive landscape of open versus closed models. Verizon's AI deal potential adds a revenue layer that few telecom stocks can claim. And on the value side, SiriusXM reporting earnings July 30th drew attention for being labeled dirt cheap. So where does that leave us? The overarching story today is a market that is deeply conflicted about AI. On one hand, you have enormous capex commitments, $60 billion in new orders from Supermicro, vast data expanding with AMD, NVIDIA and Microsoft pushing OpenAI models, Verizon closing AI deals that could add billions. On the other hand, you have investors who are genuinely worried about whether all that spending can be justified by revenue down the road. The Magnificent Seven are getting sold not because the AI thesis is dead, but because the questions about timing, returns, and the sustainability of the build-out are suddenly front and center. The contrarian view, the one analysts are articulating today, is that when companies eventually show spending restraint, whether through earnings guidance or strategic pivots, those same shares will be rewarded. Whether that's true, we will have to wait for earnings season to find out. Until next time, I'm your host for Market News. Thanks for listening.